Good afternoon, good morning, depending on which coast you're on. Welcome to McQueen Financial Advisors monthly webinar series of budgeting and planning for 2021. Hard to believe that 2021 is just around the corner, but we're only about 45 or 47 days away. So thank you all for joining us. I'm Charlie McQueen, President of McQueen Financial Advisors, and I'm here along with Craig Cecilia. Craig is Managing Director of McQueen Financial Advisors, Chief Investment Officer, responsible for managing all of our portfolios. We've both been in this business a number of years and really enjoy the wonderful people in the business and the wonderful people here in our organization at McQueen Financial. So thank you all for our clients and friends joining us and for everyone here working. If you have questions today, feel free to move on to the icon, or the bar, which may be on the top or bottom of your screen, where you'll be able to click in there and submit a question, and we'll happily answer them throughout the presentation and also at the end of the presentation. Today's webinar is being recorded and will be available for you afterwards. If you'd like, please contact your advisor at McQueen Financial, and they'll provide you a link to it or send it to you. So with that, it's definitely been an interesting world over the past 11 months this year, and a couple different turns I don't think any of us saw coming. But where we are today, we want to give a good update to make sure that everyone's planning appropriately for 2021 and some unique things. So with that, we're going to go through an economic update, talk about what we see coming in the economy and what has happened. We're then going to talk about a lot of planning, and ALM becomes an extremely important thing, and a little bit of foreshadowing. We're going to talk about margins narrowing in 2021. We're going to talk a little bit about investments. We're not going to go too deep into investments today. We do have next month a webinar Craig's leading on investments in this environment and the levels of cash that are out there today, which is truly amazing, as everyone knows. And then from there, we're going to talk a bit about a bunch of different areas, some of our valuation group activities, but we're going to spend some time talking about valuations and where they're looking. We're going to talk about some non-interest income opportunities and talk about some ideas to really rethink the future of banking and branching and where it's going to take us. And then we'll be answering some questions at the end. So with that, we'll hop in. And again, I want to thank everyone for joining us, and thank you for the continued relationship with all of us here at McQueen Financial. So as we get into the economic update, this is one of the things that's always interesting to me is we manage a vast majority of our assets under management, our bonds. We do have a number of stocks under management now, but as we look at the stock market, it's definitely been a very interesting graph here for the last 10 or so years. And we've seen obviously the big drop down with COVID, the quick recovery, and we continue to see some volatility now given elections and more outcome on COVID. But definitely a great level, which is helping out in a lot of ways, from 401k plans to municipalities. A lot of municipalities are actually benefiting from this. Is helping out some of their pension problems that they have. So the stock market has been going well, and it's definitely interesting. We go between work from home and work from the office. Stocks bounce back and forth depending on which ones today. The banking index is always something I like to look at because it relates to the viewpoint of what's happening in our industry to the overall world. And COVID has been a scare that we're going to see a lot of losses. And fortunately here, we have not seen those losses materialize. As we look at most of our clients' balance sheets, they're looking really good. Income statement is looking really good with loan losses. But there is a perception that there is going to be elevated losses, and one would expect with a pandemic, but also there's now more of a concern about commercial real estate and looking at office buildings primarily and some of the potential problems there. So definitely an interesting spot. We have not seen these recover as much, although we're starting to trend upwards. So consumer confidence is something, and we always like to start off with the consumer, because the consumer is 70% of the economy. And confidence, I see here, Craig, was looking really, really good back until the pandemic, but I think, in my opinion, we've recovered surprisingly well.
Yeah, I think it's interesting to really, Charlie, to look at that current conditions and how everybody is feeling, how everybody on this call is feeling, our customers. The current conditions is that green line there. And you can see the margin between current and how we expect the economy to be looking going forward. And coming into this 2020, it really changed up. It really did, because, we had the pandemic, and we had a lot of different things that are causing us to think, things might not be as good. So as we look at the overlap now of current versus expectations, we've come a long ways. We've had a lot of positive science taking place with respect to a vaccine for our current COVID situation. And then we also are looking at kind of corporate earnings as well. Although they've been very choppy over the last 12 months, we're starting to really look at how employment's doing, and people are starting to feel a little bit better. So we're recovering quite a bit.
Good, good. It's nice to see. Confidence obviously fell, but we're back up to levels we were in 2015. So it's coming back up. And one of the big drivers of this is actually looking at the debt and the debt to income ratios. And what we're seeing here is that actually debt is paying off. People have less debt in general. They're paying down credit card debt. We're seeing that right now. But the other thing we're seeing is the savings rate is really going up. As you guys all know out there in this call, deposits are up substantially. So we're actually seeing consumers, the average consumer, in a much better spot. And part of this relates back to the bonus unemployment. Part of this relates back to the PPP funds. Part of this relates back to it's hard to spend money during a pandemic. Although people are buying a lot of toys, as we were talking about earlier today.
Yeah, collateral values on the toys are just out through the roof right now.
Yeah, great values there. And I mentioned earlier, things are going well. People are paying their loans. We're seeing the only thing really up here is auto loans, and I think that goes back to a lot of people extending out to 100-month loans on autos, and seeing some people maybe take advantage of some of the delinquency things. But here, or some of the COVID ways not to pay, but we are seeing a little bit of a trend up in auto loans, which is surprisingly high compared to where we were in 2009 and 10. But everything else is down, and student loans are down temporarily because of some legislative activities, so we'll see what happens there. But definitely an interesting conversation about paying for student loans and paying for colleges and not attending colleges right now. It's an interesting business. With that, we have seen an amazing recovery in the unemployment rate. And looking at this, to me, it's, obviously when an economy shuts down, a lot of people become unemployed, and we're going to talk a little bit about our K-shaped view of the recovery. But we have seen the unemployment rate come crashing back down, back to under 7% in the United States. Here in Michigan, where we had the lockdown by our governor, who decided to completely lock the state down, all the way up to almost 25% unemployment, but we're back down to 8%. So we've definitely seen some great improvements here. Any comments?
I think we're going to see, as we'll talk a little bit, but there's some unintended consequences to great unemployment, and that goes down to inflation and wages, and we'll talk a little bit about that in a couple of slides.
Yeah. Well, one of the slides that it relates to inflation, it's hard to have inflation when energy costs are so low, and we'll talk more about that, but oil to me is one of the best indicators of economic activity. And why is that? Well, when people are buying things, people are driving to work, things are getting shipped, people are putting oil in cars. We're not all in electric cars yet, but we're heading that way clearly. But oil is stabilized around $35 or so, $40 a barrel, and that's not a bad spot for it. I definitely think we're not going to go back to the hundreds that we've been at. It was a political viewpoint, I think, back for a number of years. But I think as the economy continues to improve, we should see oil head up to $50, $45. But one of the great recoveries, and we can watch it here, definitely in Detroit, is auto sales dropped dramatically again when you close dealerships and you can't sell cars. Then we saw a recovery of sales, but what's been interesting to watch is the inventory turn is still down, and then we've actually seen a lot of supply problems and the slow going back to ramping of production. And we're seeing this in a lot of industries right now. And supply is down, making car prices, as you mentioned earlier, toy prices higher. Car prices and used car prices are higher based off of supply and demand today. Well, this is one of my favorite graphs because it makes you feel good if you own a house and makes you feel terrible if you don't own a house today. but new and existing home sales. And existing home sales are going great because people are moving from used homes to new homes. But what's also is exciting is that we're getting, and I think we finally come out of the recession of new home purchases, new home construction. You know, we were up in the $1.2 million, $1.3 million range back in 2003, 4, 5, and we've never fully recovered. And a normalized rate before the housing crisis back in 5, 6, 7, it's really bottomed out in 8 there. You can see the numbers. 800,000 is more of the average, and we've been below that average for 10 years. So it's really interesting to see.
Yeah, if we look, this chart goes back probably, 15 years. And if we kind of look back farther than that, pre the boom, economic boom that, started in 2005, 6, we're at a good level actually for a housing market and supply and demand. What's really tantamount is where is rates going to go in 2021, and how much can accommodative lending support the continued growth in this sector?
You did say rates could be low for 4 more years, like a month ago, so I'm okay. I think they'll be low. Well, speaking of that magical thing you talked about earlier is inflation, and the Federal Reserve has come out and said that they are going to favor more inflation than less inflation. And they figured, and I think a lot of us understand that if we look back 2008, 9, 10, 11, 12, when asset values were less than the amount people borrowed for them, it was a bad day. And so we don't like deflation in our industry, and the Fed gets that. They support our industry, and so they're looking more towards inflation. With that, do you see the Fed changing rates anytime soon because of that?
No, counterintuitive to what actually the Treasury market has done. We've seen that 10-year pop up, just under 1%, where it was mid 50, 60 basis points for quite some time. And that has to do with anticipation of spending and the programs that could come in the next few years. But even if we do have some inflation pop up, call it 2.25, 2.5, as long as it is not going to go farther than that, I think the Fed's going to be extremely accommodative to let inflation run its course and leave the overnight lending rates where they're at for quite some time.
It's interesting. I think inflation is going to be low, but speaking of change, this is what we call the whipsaw. Again, like the unemployment rate, you close down an economy, it falls down. You open up an economy, it goes back up. I really can't wait to see the next couple quarters and how this normalizes out. GDP is we're looking at quarterly numbers here, but eventually we need to annualize and different things. But it's fun to watch it bounce up and down. It's good to see it come back. Not for all industries, but it's definitely coming back the right way. All right, so here is the yield curve, and as Craig mentioned a moment ago, we're at 94 basis points as of a day ago here on the 10-year Treasury, and we're down quite a bit from where we were at the low point in 2012 on the 10-year Treasury, which makes this a flatter yield curve comparatively. You keep telling me, Craig, it's a steep yield curve, and I just call it a low yield curve.
Yeah, and you got to think about it from a relative standpoint in the marketplace. The spread between the 10-year and the 2-year. When you're standing at around just under 75 basis points or 70 basis points on average over the last couple of weeks, that's a wide spread between 2s and 10s. You look at historically over the last decade, we've been in 50, 40 basis points, and I'd love to see it get back up to 100, because it really just means we can manage our balance sheets with not having to worry about too much compression on our margin. The steeper the better for us when you think about the structure of all our balance sheets on the call today.
Yeah, it's really coming down to the margin discussion we're going to have in a little bit here.
Yeah.
The steeper yield curve helps, and the yield curve was steeper in 2012. It's gotten much steeper now, as we talked about. We're at 60 basis points in the 10-year Treasury, so we've gone up 50% yield. Not often you get to say that in a normal conversation. And one of my favorite graphs, those of you that have known us for a long time, we just love this graph, and reason being it's really showing the shape of the yield curve over time and how the Fed is pushing rates and modifying rates. And we can see the cycle we went through from 2003 through 2008, and then we've gone through that cycle again. And we're seeing in really 16 rates coming up, peaking out, going up too high, then immediately coming down with the COVID activities. And even before COVID, we had a lot of discussions about how the Fed overdid it. They over-raised rates and were starting to choke off the economy unnecessarily as it started to grow. And so here, we're starting to head back the right way. We have the 10-year Treasury starting to break back out again to a higher spread, and we're moving towards a more normalized yield curve, albeit a very, very low yield curve.
Certainly.
As we look at our predictions, one of the things we like to look at a lot is international bond yields. And why do we do that? Well, you know, countries are similar, and if I'm a bond manager, I can buy different countries, but I'm going to probably look at the ones that are similar to mine. So we look at the US 10-year, the United Kingdom, Germany, and Japan, all reasonable, economic, free countries, and we're all grouped together between -1% and 1% right now. And then we look at the other people in the world. China, obviously, it's a very non-democratic country, and Brazil has its own set of problems right now. So I think one of the things for us to see significantly higher interest rates, it's going to take all these economies to have higher interest rates. And given the impact of COVID and economic challenges, I think it's going to take a while. So want to just throw this in here to really start to show some of the volatility, but also the lack of volatility. This is one thing I mentioned a moment ago, that we've gone up 50% in yield in the 10-year Treasury. The 10-year Treasury has a history of a lot of movements and not being completely stable. But we've seen here, we've been in this relatively low trading range for pretty much all of 2020 so far.
Absolutely. And it's interesting, when you could go back to, say, 2016, when we were said, wow, the 10-year is going down to 1 3/8, and we've never seen that before in our country as a history. And you see where we went down this year. So, you know, I wouldn't be surprised if we see some more volatility going forward, just depending on the latest and greatest economic news. And I think that's one of the things that the Fed is sending out a message is with this inflation target is, hey, it's okay if we get outside of our long-term normalized range. We don't want to see a lot of volatility. But it's hard to really, lead a horse to water and say, hey, if there's one number that comes out, let's not overreact on this. But we will see some more volatility in this 10-year part of the curve for certain.
And if you look at the Treasury as an indicator of forward inflation, the Treasury market does not think there's any forward inflation at this point.
No.
So, just a little update. Again, everyone, we've talked about this, but we've gone through the stair step up of the Fed raising rates dramatically, 16, 17, 18, 19, and then coming down very, very dramatically back to the 25 basis point range. One of the things that is important to always remember is that the Fed funds rate, what's quoted and what people are paid, and the implied forward rate gives a little bit more of a expectation-based activity here. And, you know, the market's saying we're going to be at 8 basis points. And we're seeing that cash yields are going to be low through now January of 22. So it doesn't make sense to sit on a lot of cash and hope for rates to go up. And we might see a drifting up of some of the longer-term treasuries here or there coming back down, but we're not going to see the Fed funds rate or cash rate change anytime soon.
Oh, and that's why it's so crucial to just manage those cash investments, you know, and we're going to talk a little bit more about that a little bit today, and then in December as well at our next webinar about duration management.
So one of the things that is definitely causing concern in the market and concern, and you're hearing people talk about potentially modifications to the stock market again in the news the last couple of days, COVID cases have definitely shot up, and this is infections around the country. We've broken some levels here, and you can see that today is the dotted line of November of 20 on the right. We've been really spiking up. Now the projections are always interesting. Are they right or wrong? Fortunately, none of the projections back in March were correct, and things came way back down. But we are seeing a broad-based increase of COVID-19 infections, which could end up causing the country to start closing down, or different parts to close down. Here locally in Detroit, it was announced today that the Detroit public schools are closing again, and we've seen a lot of school systems shut down, which puts a lot of pressure on obviously parents, but also employers, as something that we have to be understanding of and work with. But also we've now seen a number of banks start to close their branches again. Just yesterday, I read 3 different clients of ours are closing their branches to outside people and using drive-up and ATM transactions only. I think it's a great reminder that back in March and April and May, We were able to do that, and we can do it again now. And as we really think about our alternative delivery methods, I think people are going to be less apt to go to financial institutions anytime soon because, frankly, they figure out how to do it without walking in the door. I like taking pictures of a check if I get it versus having to go in somewhere. It gives me another 5 minutes during the day to probably do something I want to do.
Absolutely. I think it's going to be a mindset change for, I don't want to say indefinitely, but let's just say indefinitely, on how our clients are going to be behaving going forward.
Yeah, it's definitely interesting. And unfortunately, but also predicted unfortunately here, COVID-19 deaths have been relatively low relative to the viewpoint and the projections and where we were back in April and May. They are projected to go significantly higher. Hopefully that's not the case, but that is starting to put fear. And when fear gets in the economy, people start doing things differently and stop going places. And again, I expect remote banking, all of that to substantially spike up, internet-based banking, phone-by banking, if people still do that. But hopefully here are some of the new drugs that have come out, the one by Pfizer, which is hopefully going to be a good vaccine, and there's also Eli Lilly's come out, one that hopefully makes the symptoms worse, or less worse, and less worse, so that's a great word, not as bad and not go into the hospital. So we're looking for some positives there. All right, so a lot of people talk about recovery and income-based and different components, and we don't see it that way at all. We see it as a K-shaped recovery, and the best way to explain it is everyone else is on top, and things are going well. They've been able to pivot. A lot of industries, banking industry, for example, has been able to pivot. Insurance industry has been able to pivot. A lot of things have been able to pivot and work forward in this environment and put in, even in manufacturing spaces, put in appropriate safety guides to make things work and for autos, for example, to still be built. We are definitely seeing the problem on the bottom half of the K, which is the resorts, hotels, conventions, transportation, travel. I haven't been in an Uber in 10 months, so it's kind of interesting to think how their revenue is. But obviously a lot of those industries are going to struggle. And where we look and see people having losses in their loan portfolio, it's if they are concentrated in one of those bottom groupings, and maybe add bowling alleys and some bars in there and some restaurants. We've seen some restaurants do real well in this environment with takeout. A lot of the fast food restaurants have done quite well, but it's definitely a challenge in this environment.
Absolutely, and we did see a little bit of, as we saw COVID numbers come down, we saw a little bit of resurgence on receipts, even in the airline industry. And as things spiked, you can see that whole volatility of revenue stream for the industry, travel and leisure. And there is some good hopes, though, with a vaccine coming, and we'll see a little bit more recovery. But I think that industry as well is going to take a long time for it to come back, even with a vaccine that's going to be coming out.
Yeah, it's a tough spot to be stuck on a plane with a bunch of people. It's just mentally a very difficult spot today. Mm-hmm. Well, we gave out or put out our economic update last month for projections for next year. And we'll go through it a little bit here. And we actually didn't change them, so we can show where we're off already and not, but we're actually fairly close to where our expectations were, and the market is moving the way. For example, we had 80 basis points in the 10-year Treasury and 1% by end of first quarter. So I think we are heading that direction. We're seeing things move there. But overall, again, we expect Fed funds rates to remain extremely low, prime to not change, Treasury yields to remain low, and we're going to see some improvement in GDP, but inflation is going to stay benign. So it really summates everything we've talked about. Yeah,
and I think the key is looking at that second from the bottom row there is, what is the economic expansion going to be for us, for the United States? And positive. It's going to be positive. There are some good things happening. Challenges, most certainly. But, we're expecting low to moderate GDP growth for the next year. And we're the Fed to be accommodative to help that move along, because we got to remember, we do have a lot of government spending programs going on right now.
One or two. I did make this little example the other day. If we do get a good vaccine that works, and if it does get rolled out, and if people do take it, so there's a lot of ifs in that sentence there. I do think if that all happens by June or July of 2021, it'll act a little bit like a 2-liter bottle of Coke half full that's been shaken for 9 months. I think the economy is going to explode. And I think we have really good economic activity as there's a lot of pent-up demand. We'll see if we get there with all those ifs, but it looks to be more positive on the horizon to me than negative based off of everything we're seeing today.
Well, I just have to add, Charlie, I have a child at home, and it's not the 2-liter bottle exploding, but you got to drop that little candy in there to make it explode.
Oh, the Mentos.
The Mentos,
that's right.
there you go.
So we're dropping Mentos into the economy now. All right. On that note, we'll roll into the ALM here. And, why do we want to talk about ALM? Well, I think as we think about the future and what's happening in 2021, we know a couple things as certainty, and we don't know things, but some of the things we know as certainty is that the money supply is substantially higher. There is a lot of cash, We've grown more, the money supply has grown more in the past 6 months than the previous 4 years. And we look at that, that means that you're going to have cash, and cash is going to be with you for the foreseeable future. But this also means that this is going to be difficult on margins, because we're not able to grow loans that fast right now for a couple of reasons. One, a lot of uncertainty, tough to make loans. Two, a lot of people have cash, they're paying down loans. And then, where we go from here, again, is an unknown spot.
Absolutely. Just one quick comment here is, if you look here, this is a long-term graph, right? Mm-hmm. And how many times in periods, if just looking at that graph, do you see where that money supply has gone down in reality on a long-term trend? So I want everybody to really ponder that and think about liquidity on their balance sheets and what's going on in the economy. It could be historic, quite frankly, where it can come down a little bit, but I don't expect it to come down a ton. You can't drain it that quickly. You'll shock the economy.
If you go back and look in 2008, 2009, you can see there in the gray bars, we had a boost up of money supply with the financial recession that happened, and it never went away.
Right.
And that's part of this. As we look at this, we have these consistent activities, and I'll tell you that as the younger generations become older, the normal progression, a lot of these younger generations have seen a lot of bad things happen, and they are more savers than spenders, unlike the baby boomers who are getting older as every day goes by, as we all are, I guess. So I think there is going to be a bit of a demographic shift to cause savings to stay higher, and we don't expect these deposits to run off. But even if some do, the well-positioned investment portfolio is going to have a good ladder which can cover part of this. And I think also, it's people are apt to keep money around today because of uncertainty. All right, one other spot where we can actually see this is looking at some FDIC data. Deposits have grown dramatically in June quarter alone, up by $1.2 billion. And so we're seeing just some dramatic shifts, and in the third quarter, we're up by a little over $1 billion. And so, trillion, 1.2 trillion, excuse me, I missed a comma there.
Yeah, what's a couple zeros or a few zeros?
3 zeros doesn't make much difference. And in the first quarter, we're up $1 trillion. So just huge deposit growth we can see there, which really has come into a process of causing everyone to cut their deposit rates quickly. So cost of funds on institutions greater than $1 billion has come down from over 1% in a year to now to just shy of 40 basis points. What really surprised me is that the smaller institutions below $1 billion have not cut deposit rates nearly enough, up at 67 basis points. As we approach zero here, we've got to really make sure we're approaching zero pretty quickly.
Well, absolutely. And from the market and the coverage of our clients that have really done a very good, deliberate job in reducing those rates, it hasn't impacted their liquidity and their liquidity needs for the rest of their balance sheet. So extremely important to keep an eye on that and continue to make sure that you bring it down to market rates.
Yeah, so one of the take-homes that we'd like to have from this is to really rethink your deposit structure. People are saving money because they're scared. They're not saving money for a return. And so 5 basis points is 0 basis points effectively mentally. So I just encourage everyone to really think about that this next year. What's also very interesting, as I mentioned earlier, loan growth has been very, very small. And so here we're looking at change in loans across the country. Loans are only up about a third or a quarter of where deposits have been up. So loan to deposit ratios are going to fall and continue to fall because of this. and it's across the industry. So I just think we need to make sure that we're not fighting the trend of a higher loan to deposit or a lower loan to deposit ratio, and we should be accepting of it because it won't be forever, and it's natural given the environment we're in. So I mentioned this earlier, I decided to leave the graph in for fun, but non-current loans are just not here at all. Everyone seems to be current, and one of the things I do see is that we're seeing the larger banks starting to have a little bit more problems and a little bump up there, and we think that's related to commercial real estate. So yield on assets, this is something amazing too. We've obviously seen major changes. The large banks are cutting their deposit costs very quickly because they have to, because their asset yields are plummeting. And we're seeing them come down more slowly at smaller institutions. But I do expect we're going to lag here. But what you can see is that delta there, the difference between the two numbers, is pretty big, bigger than it's been in the last 3 years. So I would expect either the large bank yields to come up or smaller bank yields to come down, which means the smaller institutions, we're going to see those yields come down. Loan to deposit ratio, I mentioned that, but just worthy to see here, we're down now to 79% on institutions below $1 billion, and we're at 62% at institutions greater than $1 billion. That's dropped down 8 basis points, or 8 points here, actually, in the past about 2 quarters. So huge, huge decline. So looking at this, where are the earnings bouncing around here? What's causing positive and negative impacts? So we are seeing an increase of non-interest income related to PPP funds and gain on sale of mortgages. And we're seeing a little bit of a positive impact, people taking gains of sale of securities because values are up. But we're also seeing some negative. A lot of money has been reserved in credit and people not using it, but there's a lot of money in the credit and provisions right now that could probably just handle any future problems. Increase in non-interest expense is up a bit, so expenses in the organization. The net interest income, decrease in net interest income is $7.6 billion, and that is just the margin. And so we haven't seen this impact of the margin fully hit yet. This is just the beginning, and we expect to see that really continue as we go forward. Another picture of the margins. This is a net interest margin for all U.S. banks. And we can see here that the large banks really dominate when you do the divide by total assets, which they do here for the graph here at the Federal Reserve Economic Data Site. But again, now down below 3%. So definitely one of the lowest ever margins we've seen in the banking industry, and I expect it's going to continue to go lower here this next year. And one more way of looking at this, we are seeing, again, margins plummet in large banks and margins stay reasonable in small banks, but we do expect that will change. Income's down. We're seeing income down substantially. A lot of that, again, is related to, as we show, the increase of provision and a little bit of margin. But we do think we'll start to rebound here as maybe provisions are fully put in place. So, planning for 2021, what did all this tell us? And you know, Craig and I were spending some time thinking about what were the best points to give everyone. And Craig, you're talking about stress testing scenarios and assumptions. You know, we have a lot of uncertainty out there. There's some ways we could build up a framework of what are those possible outcomes to be able to understand how we may act.
Yeah, one of the things I think about is short-term versus long-term. And we've always been the proponent of not looking at just into the rear view mirror, right? That smallest piece of glass in our car. We want to really look for a longer period of time to get a real trend. We've always been a proponent of that. But I also want to, challenge ourselves, because this year could be a game changer of how things are run going forward, and with respect to, how we run our branches, how many people do we need there now going forward and stuff. And all right, this all boils down to non-interest expenses, and stress testing that. Not only as our assumptions on our interest rates got to be stressed, but we got to look at stress in our non-interest items, whether it's expense, whether it's income. It's extremely important when doing that for modeling going forward.
And I think it's really coming up with the realm of outcomes and running scenarios is not a bad thing to do, so at least you know the outcome, then how quickly you must change. One of the things that's always funny with me with ALM simulations and simulations done, they assume you do nothing for 12 months in a lot of them, and that's, that's not going to be the case. We're going to make changes, we're going to recommend changes, you're going to make changes, but it's good to know those scenarios. And I think one of the things that really hit me was you got to reimagine your business. And not only, as we've talked a little bit about branches, reimagine your business with branches closed and drive-throughs open only. That's one thing, but also what about a different makeup of the overall balance sheet? Instead of being 80 or 90% lent out, maybe you're 60% lent out for a period of time. Maybe we're looking at 40% of assets and investments for a period of time. What do I have to do to make sure that I'm working and running in that scenario and with margins falling? And it might be, before I've been able to keep my deposit costs higher, but as the amount of loan shrinks, that volume variance is really going to start to hit income, and therefore we're going to need to cut our deposit costs even quicker than we have historically.
Yep. It's a very good point. One of the other things that do come to mind when thinking about this and how 2020 has really changed the shape of a lot of our balance sheets is it's going to impact that whole back testing thing. When we get into 2021 and we're going to look at a back testing, if you're not doing it, you're going to probably be expected to because of such a different change in the structure of your balance sheet. It's so important to be looking at that to make sure that your model's working well.
Very, very, very fair point. Well, from here, I'm going to talk a little bit more. We're going to talk a little bit more about some non-interest income and PPP loan stuff relative to planning here in the next few slides. But we're actually going to hop over now into investments and talk a little bit about investments and what we see going on there and how to plan for the future for this. So I wanted to tee you off, Craig, with this slide because I love this. This is dollars deposited at the Federal Reserve Bank, but not the required reserves. And so if we look back, this chart goes back to 2008, 2009, and no one had extra money there. Then all of a sudden, more extra money was kept, and then we had this little skyrocket from about 400 billion to 1.8 trillion.
It's fascinating, isn't it?
Yeah.
One of the things that the Fed has recognized is because, quite frankly, for the last decade, the Fed's been the best game in town from an overnight cash return standpoint, purposely. And actually, that has not been such the case over the last recent period of time. And so now it's kind of looking towards your correspondence for that, the home loans for that, of what to do with the cash, because the Fed's not quite as high. But yeah, that spike is there, and eventually it's going to have to trickle back down in order to right-size what's happening in the market.
Yeah, and this always makes me think about how good the economy is going to be when things change, because there's all this cash built up, and this is just one small way of looking at it. But speaking of that, how much cash should we have on hand? It's a great question.
It really is. As you look at how much cash you historically had as, say, a percentage of your deposits or assets, it's been one number, and right now it's a huge number. I think the overall total trend has been where people have gone and increased that up to somewhere in the 20% range as a percentage. And is that that is a bet on interest rates if you're going to retain on that. And is it right to make that bet on interest rate to have that high of a percentage? We got to think about expected liquidity and how long it's going to be around. Because otherwise, you got a big opportunity cost taking place.
Yeah, big opportunity costs. And I tell you, if you go back and look at 2009, those surge deposits, they mostly stuck around. So we do have some data to utilize to at least give some rationalizations. They stuck around. And with that, we want to talk a little bit about duration, but I think the best thing we're going to do is just give this viewpoint. Don't make a bet that interest rates are rising and falling, and next month you're going to spend a lot of time talking about duration for us.
Yep, absolutely. It has to be right. I love that first bullet point, Charlie. It just has to be right for your balance sheet. And just because of the times we're in, you shouldn't necessarily change what's right for your balance sheet and your overall total structure there. Yeah, we're going to talk about some risks and rewards in our next thing about duration management of your balance sheet. But it's going to be incorporating a lot of different areas of your balance sheet in your ALM report.
Well, and that's why I look at the last bullet point is your ALM report should dictate what you do. It shouldn't be an outside viewpoint. It shouldn't be someone saying it's the best bond ever. It should be, where do your earnings look good in a rising interest rate environment and current environment, and maybe even a little bit of a falling rate environment. We don't have much to fall, but just want to make sure that we're thinking through that. We're using our ALM report to provide us with that knowledge and information. So with that, there are some interesting market yields here. I see some really colorful lines, first of all.
Isn't that pretty?
Yep, it is pretty. There's a couple up on the top there, though. What's up with that?
So it's interesting, and it's very much what one would expect if you sit back and think about what's happening in the economy. The beautiful rainbow of yields here, you can see the top ones are credit related, whether it's tax-exempt municipals, taxable municipals, corporate bonds. And we've seen some spreading going on, meaning the spread's widening on the credit-related products. So there's value out there, and with a slight steepening of the yield curve, that 2 to 10 spread being at 75 basis points now, looking at the right asset mix of your investment portfolio is crucial to be able to help offset some of that declining margins that you had talked about earlier, Charlie.
Yeah. So some decent things there, and as you mentioned, municipals, we have spreads widening. There's a big fear. People are all nervous that every municipality is going to fail, and some will. But a lot won't. And so doing the homework there really pays off.
Yep, right on. We talked a little bit about in the auto industry, what's happening, how it's doing so well, but there's also a supply issue, not enough inventory available for what the market's demanding. And you think about that in revenue bonds, Port Authority, and how much their activity has been impacted by international trade being impacted with COVID and supplies. We really got to look at that when you're evaluating any kind of investments going on to your portfolio.
Well, the same thing here with a little bit with corporates are very similar. There are definitely some disfavored markets, and there's a lot of people nervous about financials. A lot of people have been calling for massive losses in our industry, and there just hasn't. We did see Delta Airlines spike up, with COVID, with a little bit of the Pfizer news, but it's definitely going to be tough to see if that continues or people really pull back on travel now again.
Sure. Yeah, the top paying interest sectors paying in the corporate world are what you probably would imagine. It's oil and gas. It's travel and leisure. You do have the financial institutions with the uncertainty in asset quality, but they've always historically had a little bit of extra spread over some other sectors.
Definitely interesting. And this is an area that made me laugh a little bit. The first bullet point of reasonable premiums. That's such a vague word.
Absolutely. Well, with mortgage rates the way they are, even with a little uptick as of recently, we have historically low mortgage rates. What's really been important to really look at is the speeds that the underlying collateral has been paying. And one of the really interesting things we saw is that it's not 100% correlated to actual mortgage rates. It also has a lot to do with the seasoning. What is the vintage of the collateral in those securities or of the underlying mortgages? Those have a big impact on some prepayment speeds, where you can have tranches of mortgages that are lower coupons, but they're actually paying faster than some other higher, different vintage type product.
I've been in my house long enough and I want a pool, so therefore I will pay it off or refinance. Well, definitely a lot of interesting things happening in the investment world, and as we look forward to this next year, I think the advice we want to give everyone from a planning standpoint is we really need to be disciplined on duration. Be the correct duration, and again, Craig's going to talk a lot about that this next month, where we go into a detailed duration analysis and duration decisioning, but be careful with that. And what I mean by that is you don't want to be too short or too long. Credit risk-wise, make sure you're doing your homework. There's a lot of tough credits out there. And we just saw the tax activity in the state of Illinois fail to pass, and Illinois continues down its path of unable to pay bills, and so we do think there's a lot of municipalities like that, but not all, but a lot like that. And from here, municipal bonds, corporate's still the best spot out there?
Right now, there's a lot of value there. No two ways about it. We'd love to have the balance sheet take credit risk in the lending portfolio when available, as long as they're risk-based priced and have the right rate returns. but there's a lot of spread that's starting to widen a little bit. So if you don't have as much corporate risk on the lending portfolio, we can afford to take a little bit in the investment portfolio.
All right, well, from here I want to flip over and talk a little bit about some things happening in the other parts of the balance sheet. And so we call this our valuations world, but it really gets into a lot of different things and things to prepare for. And Craig was just talking about prepayment speed, so I just stop here for a quick second, and what you can see is that 30-year 4% Fannie Mae securities are paying at a 60 CPR, roughly. And what that means is 60% are paying off in a year. So huge prepayment levels, and that's something we need to continue to monitor. And where it starts to lead us a little bit to is mortgage prepayments higher in mortgage MSR values. We expect these prepayments MSR values are going to continue to be challenged, meaning older production, as Craig mentioned, and higher yield production is going to be prepaying very quickly, but new production is going to be doing quite well and should actually perform really well. So from here, we talked a little about some cash flow issues, but it's all been pretty much figured out. And I do think that we just need to be prepared for just a little bit of tough mortgage values for the foreseeable next year or so. All right, CECL. I put this up here, and it's my mindset, so don't take this as the rule. But Jan 1 of 22, my mindset is you've got to be ready to roll and that you're implemented, things are running. Maybe you're not using CECL for your actual input at this point or for utilization for loan losses, but I think you want to be pretending like it's live on Jan 1, 22 at the latest. So therefore, we've got to be running in 2021. It's a tough process of getting historical data. And so as I look forward and start to forecast into 2021, I think CECL definitely has to be on one of your top lists of things to do. We're definitely seeing data issues. There's also tough decisions on stratification of types and how to break it out and what correlates well, and then correlation. Interesting thing, and I think most of us obviously have not implemented CECL yet from an actual financial modification standpoint. But unemployment has been considered the best correlation to predicting future losses, and definitely with the spike in unemployment, it may have been pretty devastating for people that have implemented CECL already. So I think here it's a great time to really look at those correlations and think carefully about how we utilize them in a mathematical process going forward.
I think that's a really good point that you bring up there, Charlie, is that correlation, because a lot of our clients that we've been already running CECL for, not for filing, but for understanding it and getting it running and ramped up, is we have changed how we are stratifying our loans and breaking out different categories, because at first it didn't appear on the surface that they should be. Used some common sense, kind of put them in there, but as what we've been running it over the last several months, we've been seeing that there's definitely a different way to really look at some loans, and their behaviors are different. So the earlier you can get it implemented, the more you can learn so you have it right when it really has to be implemented.
Yeah, absolutely. You want to just plan ahead and be ready for it and make sure you're not going to bump into any issues. And I think this is one of the things we thought about from planning, and CECL made Craig think about this and start to talk. But one of the things we can do, and I think as we look back historically in our industry, maybe we don't move fast enough in some ways because of regulation, and we can't move fast because of regulation. But as we look at this world and how things are changing, almost like you want to assign a team of people, your special operations team, to go in and start looking at specific issues and focus on it. And here we said, basically, why don't we assign some of our top finance talent to figure out our biggest high priority items. And as we've talked about this, the margin, our margin is really going to suffer this next year and into 2021, into 2022. We just see it continuing to come down. There's things we can do, such as try to make loans. We're really good at that, and cut our deposit costs. We can continue to do that. But the other areas I think we're really going to have to be much more surgical about is figuring out some components here. And the first one was non-interest income ideas. Can we get a team set aside to really focus on growing the non-interest income or growing into the new non-interest income areas? That's something we think could be very useful. The next one is really kind of interesting. After a number of phone calls this past week, capital ratios are looking a little tough. And we've seen a lot of people struggling with capital ratios, and not from losses, not for a lack of income. Actually, a lot of people having record income, but just from the overall asset growth. And really starting to step back and do some capital planning. We think that's something that's going to be very important for 2021.
Oh, yeah, whether it's kind of managing and changing the your process for retaining those earnings, or even that going out and issuing, and raising some capital. It definitely needs to be discussed at length and in detail for the next year or so. And you kind of look at that whole loan to value that's been declining. With deposits raising, we're going to really have to right-size our non-interest income ideas on that first bullet point, right? And the capital is going to be just crucial, because we don't feel that your assets are going to shrink all that much going forward.
Yep, they're going to stay high, so what can we do to drive income? And that goes down to the gain on sales of mortgages. That's really been good today. People that have involved in the SBA PPP loans and standard SBA loans, the income has really been coming in strong, and especially as the forgiveness kicks in. And I think we're going to see a lot of people have really good earnings to round out 2020, and actually probably good top-line numbers for 2021, except when you really dig into the margin, the core operating earnings are going to be substantially lower when you take out the one-time fees. We're also seeing some of our clients that have investment services, managing money, effective brokerage services for their customers or members, doing really quite well because of the stock market. In the credit union space, there's been a lot of growth in alternative portfolios and really good earnings that have helped out there. So those are all things that have been providing people with good income today. And as we look to the future, again, thinking about what you should be doing for 2021, let's make sure we're rethinking the insurance if you haven't gotten into the brokerage business. We see people looking at the title business and trust businesses and really starting to look at a number of these activities. And one of the debates that we're hearing more and more of, historically it's been, I'm going to go into this business, I'm just going to start one. But we've had a lot of clients actually reach out and buying things. We have clients buying insurance companies that we've been helping them with, and helping them buy existing businesses to bring in to really speed up that development process. Yeah, smaller trust departments that have gone up for sale as well, of making those purchases that couldn't do it from a compliance standpoint, get a good value in it, and buying into that sort of area that helps actually bring down your timeline to get to profitability. Yeah, you can buy it and have it running profitable on day one. And in this environment, the sooner you get to profitability is definitely better. So that's really a good thing. And so we are seeing, if you don't have a good strategy or don't have the right people to build, it might make sense to go out and buy it today. So planning again for 2021. This was interesting, Craig. You brought this up to me, and I really enjoyed it, so we put it in here. But what do you mean by this, reimagining your business? Well, it kind of goes back down to the line of, we don't think that 2020 is going to be transitory. We think it's going to be a little bit of something that's going to stick with us for quite some time, for the next several years, and how we are functioning. And as you go down to a ground zero thought process, it's, basically we're trying to understand and evaluating, where's our income coming from right now? What kind of expenses do we have to spend right now? And if we were to just open the doors as a new company tomorrow, would we still do business the way that we've always done it, or would we do business the way that we've done it for the last 6 months? Right. And so reevaluating from ground zero, and then allocating you mentioned talent to put towards planning. How do we allocate our resources to make sure that we remain profitable going forward? And then I think about how are other businesses changing, and we look at all the clothing stores go bankrupt. We look at all these stores go bankrupt, and Amazon get bigger and bigger. This is speeding up the process, and so it really makes us think about this from our standpoint. Do we need the number of branches we have? Are they in the right location? Are they the right size? Are we hours of operation? Do we need to be open 10 hours a day at branches, or could we be open 3 or 4 hours a day? I really think we have to think about that, and also from a growth standpoint. One of the things, and here at our office, we do have planes fly by, so it's always entertaining when you're on a call and a plane flies over. But you think about growth is to be thought about completely differently today, because if you can grow more, that can help offset incremental things can help offset costs and keep your profitability at a reasonable level.
Right.
So going forward from here, to wrap stuff up, if you have not already, please lower your deposit rates immediately. Enjoy the growth, don't fight it, don't try to do different things. It's going to come in just because of what's happening from an overall world standpoint and government standpoint. Loans, you know, if you've got the mortgage refi business, keep running with it, don't stop. And it's not only refinances, people are buying houses. People have determined that they can't get a pool put in because the pool companies are backed up by 3 years, so they want to go buy a house with a pool. A lower loan to deposit ratio is expected. You're going to have one, most likely. Live with it. Don't do crazy things to get hurt there. Yep. Investments.
And you know, on the liquidity standpoint, stay fully invested. And or whatever your normal process has been over the last 20 years, 10 years, been really kind of strange, quite frankly. But stay fully invested. Make sure you're getting a good return on your assets wherever you can. Make sure you have the right duration on your balance sheet. And it's crucial because there's so much uncertainty, is making sure you're monitoring your credit extremely closely.
No, it's great point there. And with that, it really comes down to your overall balance sheet. Capital. We've talked about leverage and growth, and we want to be very careful with that right now just because of the amount of deposits coming in. And it's CECL. It's here. We've got to do it. And then non-interest income. We spent a number of slides just back here talking about opportunities. But I think today is a great day to start your build or buy plan, as margins are going to be tight, that we're going to need something else. And maybe we get another round of PPP funds. You never know on what's coming up here. But that may help out and get some different things. But in the end, don't panic. We're definitely going to see continued scary things in the news, and we are seeing schools continue to close. If anything, be out there and be informative and be informed with your customers or members. Reassure them, reassure your internal team members. Again, there's a number of people we're seeing go completely virtual again. Remember that everyone it's different, and to be there and reach out to them. And with that, we're here, all of us at McQueen Financial, to help out. If there's anything we can do, or if you guys need anything, we're all here to help you for the long term. And so with that, we'll open the floor up to some questions, and just want to share a couple of them. We've been asked about how independent is our GDP forecast for 2020 and 2021. Is it dependent on more stimulus from the government? What's your thoughts on that, Craig?
That's actually an excellent question. I mentioned earlier about the amount of stimulus that we've had right now. And we do expect another round of stimulus to come, by the way, once people could get together and kind of get some compromising going. But our recommendation or our prediction on GDP is not tantamount on that GDP stimulus, although right now we can't forget the amount that we're being supported, the government supporting our economy right now. There's no two ways about it. If they don't come to a conclusion of saying we're going to have another round of stimulus, we still are going to have a very low positive GDP with a little less volatility. Keep in mind that roller coaster ride of GDP, down 32, COVID-related, popping back up with a positive 33, that was event-related. And once again, our economy is not broken, but it needs a lot of work. And so we still think we're going to have a little bit of low to moderate growth, even without more stimulus.
Well, with that, we were asked another question here, a couple others, and one of them is, will these slides be available? Yes, please. If you'd like a copy of the slides or the presentation itself, please reach out to your advisor, and we'll happily get them off to you. With that, it's 2 o'clock on the button here on the East Coast, and we really want to thank everyone for joining us today. We appreciate the relationship with all of you, and we appreciate the time you spend with us and an awesome team here to support you. If anything comes up we can be of help, please do not hesitate to call. Thank you, and have a great November.